And welcome back. In this video, I am going to explain to you how the forex market works. This is the second video I'm making in this series I'm starting on how to trade the forex market online and make profit. I'm going to explain simply how the forex market works to you in this video. The forex market, short for foreign exchange market, is the largest and most liquid financial market globally where currencies are traded, bought and sold. Unlike stock markets, which have central exchanges, the forex market is decentralized, operating as an over-the-counter marketplace. This means that instead of a single location, forex trading happens electronically worldwide, 24 hours a day, during weekdays, following the sun across major financial centers like Sydney, Tokyo, London, and New York. Understanding how this market functions is essential for anyone interested in trading currencies, whether as a beginner or seasoned trader. This video breaks down the forex market structure and mechanics in simple terms. Decentralized market structure. The forex market has no centralized exchange or physical location. Instead, it works through a global network of banks, brokers, financial institutions, corporations, and individual traders. These participants trade currencies directly between each other electronically. To make sense of this seemingly complex ecosystem, the forex market can be visualized as a hierarchical ladder with different levels of participants. One of the participants are the interbank market. At the top are the largest banks, trading enormous volumes, millions or billions of dollars, with each other, either directly or via electronic brokers like EBS and Refinitiv. This market sets the benchmark prices for currencies. And sometimes these big banks are called the market makers. Then we have the retail brokers and smaller banks. Below the interbank level are smaller banks, brokers and financial institutions who provide access to the market for smaller participants. Retail traders are the next in line. These are individual traders. They access the market through brokers who aggregate prices and liquidity from the upper levels. This multi-tiered structure ensures immense liquidity, enabling quick execution of trades and tight bid-ask spreads. Now, what are the key segments of the forex market? The forex market consists primarily of three major segments. Number one is a spot market. This is where currencies are exchanged on the spot at current market prices. The next one is a settlement, completion of the actual currency exchange, usually occurs within 2 business days due to banking procedures. The next is the spot market and is the most actively traded segment where most retail trading happens. It is characterized by high liquidity and immediate trade execution. Now, apart from the initial one we have looked at, there's also what is referred to as the forward market. The forward market involves contracts to buy or sell currencies at a future date with a fixed price agreed upon now. So, these contracts are customizable and used mainly by businesses and financial institutions to hedge against future currency risks. Then you have the traders. The trades are OTC, over the counter, and not standardized like in exchanges. Then we have the futures markets. This is similar to forwards, but traded on regulated exchanges with standardized contract terms. Now, traders use futures to hedge or speculate on currency price movement. Then we have this one, the futures market is less flexible than forwards, but tend to have higher liquidity and transparency. Now, let me tell you how prices are determined in the forex market. Prices in the forex market arise from supply and demand dynamics influenced by, number one, economic data, inflation rates, employment numbers, GDP growth. Then the prices in the forex market are also determined by the central bank policies and interest rate changes. Then political and geopolitical events also influence prices. Let me try to explain some of these things. Let's assume that the Euro USD, there's an economic data that came out concerning the US dollar, which is USD. And that economic data happens to be positive for the USD. What do you think is going to happen? The value of the USD will rise. So more traders are going to buy the USD. So if that value of the USD, based on that good news for USD, rises, and you go in the direction where the USD is going, in the Euro USD, USD is going to be going down. So if you are selling, that means you are in the direction of the USD, you are going to be in profit. If the news is positive for Euro and then you buy, that means you are in the direction where the Euro is, you are going to make profit with that. Now, central bank policies. If the central bank of Europe or USA of a particular country is making a deep policy which is positive for that currency is going to you can go in the direction of that currency, whether to buy or to sell. In the case of Euro USD, if the Central Bank of America is giving out a news which is bad for the USD, that means Euro is going to benefit. So you buy Euro. But if it is in the other case, then USD is in the other side, which is Euro stroke USD. You should go in the direction of the USD, which is going to be down. Now, apart from this, political and geopolitical events also will affect how prices will determine how the price of a particular currency. If in USD, for example, there's a war, and then there's war in USD, and many things are cut off, it's affecting the USD, the currency of the United States dollar will be affected. So what will happen that the USD is going to plunge. So the Euro against USD, Euro is going to rise against the USD. So apart from this, market sentiment and risk appetite. What is the market sentiment? What is the risk appetite of people who are buying and selling? If the risk appetite favors Euro, that means Euro is going to rise. If the risk appetite favors USD, that means USD is going to rise. So if you are trading USD JPY, and USD is favored, it's going to go in the direction of the USD. It's going to rise. Then another factor for the price is trade flows and investment trends. If people are investing more in US stocks, US things, US goods at a particular time, it's going to favor that currency, and that currency will do well against any other currency it is paired with. The constant interplay between buyers and sellers on the interbank level sets the benchmark exchange rates that trickle down to retail traders through brokers. Now, here are some trading mechanics. Forex trading consists of simultaneously buying one currency and selling another in pairs. For example, buying Euro USD means buying Euro and selling US dollars. Traders speculate on whether the first currency will strengthen or weaken against the second. You can see I've explained to you. If a news comes out and it favors Euro, then you should buy the Euro. And as you are buying the Euro, you are selling the USD. So you're going to make money from that. Now, if the news is profitable for USD, then you go in the opposite direction, which is that you are selling the Euro and you are buying USD. That means you are selling. So what you are selling is Euro, and then you are buying the USD. So that is how you make your money with this. Now, traders speculate on whether the first currency will strengthen or weaken against the second. Trading platforms provided by brokers give real-time pricing, charts, and other management tools. Traders can use leverage to control larger positions with smaller capital, but this increases both potential profit and it also increases potential risks. Now, let's talk about the trading hours before I move to the next one. The forex market operates 24 hours a day during weekdays. That means on Monday, when it starts on Monday, usually it starts on Sunday night around 10 p.m., sometimes 11 p.m. Nigerian time, depending on West African time, depending on where you are. So when it starts around 10 p.m. on Sunday, it continues until around 10 p.m. on Friday. It doesn't take a break at midnight on Monday or at midnight on Tuesday, or at midnight on Wednesday, or at midnight on Thursday. It doesn't take a break until Friday. So when you start on Sunday, it doesn't take Sunday night, doesn't take a break until Friday night. So the forex market operates 24 hours a day during weekdays because different markets open and close around the world in staggered time zones. It starts with the Sydney session, followed by Tokyo, then London, and finally New York before the weekend closes the market. This continuous operation allows traders flexibility in choosing trading times and strategies. So this is Dr. Olubenga Adetritun YouTube channel. On this YouTube channel, I teach you how to make money online and offline. And many of my viewers have requested I should make a video for them, teaching them how to trade and how to trade the forex, how to trade forex online. And that is what I'm doing. So you can use my broker, which I'm going to leave in the description section and the comment section. Click on it and register so that I can be the one that referred you to that broker. They are very good. By understanding these components and market workings, beginners can better navigate forex trading and develop informed strategies based on how these massive financial markets operate. So this is I'm going to stop on this one. I'm going to move to the next one, which is understanding currency pairs and quotes in forex trading, the major, the minor, and the exotic currencies and the exotic pairs. So that is what I'm going to be moving to in the next video. But before then, this video popping up by the side for my channel is the next one you need to watch now. I'll see you in the next one. Bye for now.